All right, guys, welcome back to the Canadian Real Estate Homefront Podcast. This is episode 32. We have a guest on today, which we're really excited about. His name is Jack from Burnstone Capital. We're going to talk about all things economy, where he sees things going, and how he kind of built himself up. So welcome to the show, Jack.
Yeah, thank you guys for having me. I'm excited to be on.
Awesome, man.
He's a new realtor as well. Well, I guess not too new.
Yeah, it's 4 or 5 months, so still pretty new. Feels like it's been longer than that, but yeah.
Yeah.
So you wanted to get your real estate license just because you were heavily involved in real estate already, and it just made sense for you to get your license too, right?
Yeah, I had a corporate job for a long time, so when I planned out my transition from real estate on the investing side, part of my transition plan was like, okay, it makes sense for me to have my license to manage my own transactions.
Yeah. And
then as my coaching business evolved and some of the other things, it just kind of made sense to probably get it to run an active business too. So
yeah.
And you know how things go. You start a business, things develop, it gets further, you build opportunity. And when you have kind of like an ecosystem around real estate, like leads start coming from different areas. So
right.
It was a business that I probably wasn't expecting to be in. It's
Yeah.
probably hard as I am now, but it just makes sense.
Yeah. Awesome.
What is
good.
Burnstone Capital? What do you guys do?
I think talk more into the mic.
Yeah, so I think for me, originally what it was is just basically being an asset manager. So I was just buying properties, multifamily properties in southwestern Ontario. And after a while, I kind of realized that that's where my true passion lied. So I wanted to just accumulate more assets. And then after a while, I started, a coaching business with it on people who wanted to follow the same journey as me and create freedom from their corporate job by owning multifamily real estate. And then it kind of branched out there from a lending arm. We have a broker business, our syndication and partnership side, and then also my main business, which is just running my real estate portfolio.
Very cool.
Nice.
Okay, so if we want to break that down a little bit, because I had a couple people reach out actually from the podcast, which is cool. Just side note, love when people reach out and want to work with us. So keep doing that.
Keep reaching out.
Keep reaching out. But some people, for example, if they have a certain amount of money put aside and they want to buy an investment, let's say, working with somebody that on a cash flow, or I guess just cash in the bank perspective, maybe not at that 20% mark if we're going to buy something over, $700K. It's a lot of money. Nobody has hundreds of thousands in the bank. It's usually tied up in investments. So my approach is, well, on your primary residence, if you're mortgage free, there's opportunities like HELOCing your house for part of a down payment and using the bank's money to leverage yourself so that you can further grow your asset portfolio. So because you're a coaching business, I'd be interested to hear and I'm sure our audience would be interested to hear how to get your first one. If you don't have a couple $100,000 in the bank, but you're mortgage free, how do you start? Do you start small? Do you go right to the 6+ unit, which makes it a commercial mortgage? What would be your, hey, here's my answer to somebody that wants to invest and doesn't know how to begin and doesn't want the typical single family that's, too much in a mortgage payment right now?
Yeah, so I'd say there's two options. If you're someone who's starting off the ground, let's say you got no money, but you have a dream and you have some ambition and you want to get in your first property, I'd say the first thing to do is look at some sort of joint venture structure that makes sense. So I've had a bunch of students that have done this structure and it works out fairly well.
Just to interrupt, a joint venture, to those who don't know, would be partnering with somebody that also has half or however much percentage of a down payment and then do it together. So it just means partnering with somebody else, a friend, a brother, an uncle.
Exactly. Yeah. And the term joint venture isn't a cookie cutter thing. It could just mean some sort of partnership, in anything, and basically how you structure it is up to you. It's like a free floating word. It's whatever you make of it. But a common structure when people come to me and they want to get in their first property, essentially what we do is we try to put them in a joint venture with someone that makes sense. So really common, the procedure is we find someone who maybe can qualify for a mortgage with 5 to 10% down. And then we find someone who can't probably qualify for a mortgage anymore, but they have some sort of liquidity. And then usually what we do is we match them up on a 50-50 partnership, as long as the synergy makes sense. They can go buy a $600,000-$700,000 asset, which usually is going to be duplex or triplex or something like that. We usually push for triplex because the extra unit makes a difference on the cash flow. And then what they'll do is they'll be able to come in and lock up that asset with only putting $35,000 or $40,000 down. So when you bring kind of a mid-level investor who's maybe capped on the amount of mortgages they can have, but they do have some liquidity of 30, 40, 50,000, and then you partner with someone who's really ambitious, wants to get in the industry and wants to get their first asset, they can qualify for the mortgage, hold the debt in their name, and then the other investor who comes in, who maybe is a little bit further in their journey and has more liquidity, can come and provide that down payment for them. And I've probably had 7 or 8 students do this. And then after 12, 24 months of holding the asset, doing forced appreciation, which basically means doing strategic renovations of the property to increase the value. Usually at that point, they're refinancing the property, and it allows them to get into their own property at that point.
Right.
And that's just one of the many ways. You know, the other way I always tell people is if someone's super ambitious and they want to do it themselves, biggest thing is just focusing on changing your active income strategy. And I always push people towards sales, because software sales or just sales in general in Ontario is pretty lucrative, and most people can start off around like a 6-figure income right away. So just depends how ambitious someone's goals are and where they want to be. If someone really wants to grow like a real estate portfolio, you know, that's a whole different strategy. But if someone really wants to get into the market, no matter what the circumstances are, even with house prices being at what they are now, you can still do it. There's a bunch of different ways to still pull it off.
Mm-hmm. Right. Yeah.
Were you looking with these students, like you said, you kind of triplex stuff like that? Like, it's probably not in Toronto, I'm assuming. Is it other parts of Ontario?
Yeah, tertiary markets. So I would say since COVID, you know, people started pushing away from Toronto because prices just drove people further away, right? But now as prices regress, you can actually come closer to Toronto. So I would still say Toronto and Mississauga probably aren't good places to invest as of yet. But places like Hamilton, Brantford, even some areas like North Burlington, Barrie, Aurelia, Innisfil. Right. So, you know, there's a little bit of push and give, right? If you want to get in the market and you don't have the money, there is some sacrifice you got to make. You probably can't buy your dream house on the first one, or buy, you know, that amazing rental property in downtown Toronto that you've always dreamt of.
Yeah. Brooke says that on the podcast too, and I always agree with it. Is like, if you really want to get into the market, buy somewhere else that like you're not going to live. You can still rent in Toronto, but try and buy an asset in like Hamilton or something like that, and then kind of work your way up through the property ladder that way.
And I'm big on, so when people come to me and want to invest, especially with where the mortgage rates are now, I'm so big on ignore cash flow. Like, cash flow is for when you're retired, you don't have an income anymore, and you're going to live off your cash flow when that property has so much equity that your mortgage is so low, and then all of a sudden your cash flow is so much higher because the debt on the property is so low. So when it comes to people saying, what should I invest in? I'm more of the buy something that's way under value compared to where things were, knowing, okay, if, you know, the cities keep growing at the rate they're growing and, you know, infrastructure is building in certain cities, Hamilton being a big one, buy something that, you know, next door maybe would have paid $400 to $500K higher in the peak, ignore cash flow, break even, make $1 per month, be negative $50 per month, because cash flow is not going to make you rich. Cash flow is something to live off of once you're retired, and the goal is to make that equity appreciation over a certain amount of years.
Mm-hmm. Cash flow is essentially an illusion in the first 5 years of real estate.
Cash flow is an illusion. Like, even being mortgage free and having cash flow, like, don't do that, because then you've locked up so much of your money on a property so that you can get cash flow. Like, I would break that amount of money up, even if you have to joint venture on one, if you don't qualify for 2 mortgages, so that your equity can build, because that's going to make you true wealth. The $200 a month, even $1,000 a month, it's not going to make you rich.
You hit the nail on the head there. So I always say to students, I say, what's going to change your life? Is it the $250,000 of appreciation on the property, or is it the $1,200 a month that you get in cash flow? Like, $1,200 a month nowadays doesn't get you very far. Maybe, you know, you and your girlfriend can go for dinner once or twice, and it maybe hits half your car payment. But the $250,000, that might get you into 2 properties in the future, or it allows you to get the car you needed and, you know, buy another property or help someone out you need to help. So when I look at, you know, from an investment standpoint, where you can go, if you have someone like, let's say, North Bay or Timmins, which is on the far left, which is very little appreciation but really high cash flow. And then on the right side, you maybe have downtown Toronto, which is no cash flow but super high appreciation, and also maybe a bit more consistent. The investment strategy that I teach and I believe in is somewhere in the middle, which I call like a hybrid approach. So you want to buy properties that are in good appreciating areas, but also have cash flow, positive metrics in it, even at a high interest rate. So you don't need to be cash flowing hundreds or thousands of dollars, but at a 7-8% high yield environment, it's at least got to break even and hold itself.
Yeah. That's my approach, is it's just got to hold itself. So some people say, well, why don't I do, because I'm a big believer in the 2-unit undervalued duplexes in Hamilton. Like Cortez said, your bread and butter. I just believe in them so much because this is what started my real estate portfolio and has really set me up. I've refinanced. They're breaking even now, but none of my own money's in it anymore. So they say, well, should I get a triplex? Just kind of like what you were saying. And obviously there's investors that want to go that route that work with you. But I'm more of triplexes are good for the cash flow perspective. But in terms of even appreciation, I find that triplexes, they'll go up, yes, but it's strictly an investor's property. Like you're not going to see a family in a bidding war per se on a triplex in a peak marketing, maybe if it's nice, but as much as a duplex that has a basement suite, but then can also be a family home in a good neighborhood. Whereas a triplex, it's 3 units, especially very separated, it very much is an investor property. So that would be more of if we're looking for cash flow, maybe, this is later on in your building like portfolio, like later on. Right now, I think it's important to get something that your appreciation and able to force value in it to be marketable in a peak market to families and investors, and not just have investors as your buyer pool, is smart.
The duplexes is like a common story for everybody. I think everybody, like pretty much most investors start their story off with, I bought a duplex.
Yeah.
It's just like a very common thing.
But it's almost foolproof. Yeah. And I don't want to say foolproof because everything has risk, but it kind of is in a sense. Like you buy something under value, it breaks even for now, so it carries itself, and then you hold it until it goes back to where the prices were. And it's inevitable that they will. It's just however long it takes. And then you use that money, that equity, pull it out when the rates are lower. So then at that point, you hope to still break even with a lower mortgage rate. Now your money's out of it. Your tenants are paying your mortgage, but you don't have a dollar in it anymore. Now that just sustains itself over there. And then you use that same down payment to go buy another one. Then that property having cash flowing or breaking even now doesn't look so much like a debt because you can use that rental income to then help you further qualify.
You're essentially using the burst strategy.
Yeah, yeah. And then I never say to buy the nicest one on the street as much as those houses will be more attractive to a buyer. Like, oh, this is pretty. I want to get this one. I'll get higher rents. But I also want there to be a little room to force value. We want the structural and the furnace and the roof and those components to be solid. But to be able to force value so that when it comes time to appraise your property, your appraiser's not saying, well, you're looking for a payday on simply market appreciation. They don't like that. They want to see that you've put some skin in the game, and then you can use your, invoices to show what you've done to the property to further the valuation come appraisal day to then get your payout and hopefully get as much money out as possible without breaking yourself into a negative monthly cash flow situation.
Yeah, 100%. It's, going back to what you were saying before and like tying in the duplex to your first property, right? Like, I bought my first property as a semi-detached house in Oakville, and I severed it into a duplex. So I house hacked it. So I lived in one unit and then brought in supplementary rent from the other unit. And I would say that was probably the catalyst from that moment of like realizing that I really liked real estate. And the reason why was because the lower unit, which was above grade, I was trying to get $2,200 a month for it from the tenant. And the tenant came to me and he said, listen, I'll give you $2,000 a month, but I'll give you a year up front. And he said, the savings that I'm getting from paying you a year up front and getting that price reduction is essentially more than I'm going to get in the market. And I said, okay, yeah, like that makes sense. You're going to get a higher instant return on your money. You have the cash flow available. But for me as like a young landlord, when I was like 24 and I got a brick of $24,000 in cash, and I was thinking like, man, it's so hard to make this like from a corporate job just to get $24,000 cash like that. And all I did was just provide him keys to a house essentially. I was like, this is a way better income producing stream. And then from there, you kind of build from it. Mm-hmm. But going back to the duplex thing, I was at in a conference about a month ago, and I was speaking to this guy who has 14,000 units.
What?
Yeah. He's got 2.1 billion under management, and he started from a duplex. It was the same thing. Same idea. And you expect when you talk to these guys that they're going to have some like insane story of, I had this, I did that deal, like something crazy. And almost all of them, when we were there, and I asked them all, like, oh, how'd you start? And it was almost all the same thing. I started from a single-family home flip. I started from a duplex. I started from a triplex. So I feel like most people kind of start from the bottom with that, but it's just up to your ambition level of how far you want to take it.
Yeah. I just want to touch on something, too. I think we are talking about, ignore cash flow. But I do think that what I'm seeing in Toronto right now is these distressed sellers. And I like how you guys said duplex for sure. Cause I'm looking at these projects that people bought. Cause a lot of people start with condos.
Yeah.
Toronto condos, it's like, or like any sort of condo. So they go pre-construction, overpay because they have a call option in the future. So they pay a premium for it. It's gone against them completely. And now like you run the numbers on, even if you bought in like 2019, you run the numbers today, your negative cash flow, $1,000. For a lot of people, they can't handle that. This is probably going to be a lot of distressed sellers coming to the market in Toronto, especially condos. We're already in a buyer's market in Toronto. There's 6 months of inventory.
There's 6 months of inventory in Toronto.
Yeah.
No way.
Yeah. Coming up on that. So you're in
It's
buyer's
been-
market
it hasn't been
territory.
that bad since like 2017.
Wow.
So like a lot of people in Toronto, if you think about it, you put your money in and you're back to say 2019 prices. You gain nothing. And now you're negative cash flow, $1,000. You haven't even got appreciation. So I think it's important to think when you are investing is where am I investing? Like I'm not that bullish on Toronto right now. Just like looking at the sales to new listing ratio, like Toronto is not, they're seeing a lot more new listings than sales. And you start looking at other provinces like Calgary, like even like Saskatoon was ahead of them. Like it was crazy. Ontario is very quiet right now. So I wonder if a lot of investors or even just first-time buyers are just going to other provinces because of affordability, maybe even cash flow, or maybe they're trying to see where the puck is going. So I don't know. Are you still bullish on Ontario? Or are you like a little less bullish because prices have just really just
I think
doubled?
I'm more bullish than ever. Like I would say from the broker side, I pretty much specialize in only investment clients, and I would say they're more active than I've ever seen them. So people that have liquidity right now, instead of maybe buying one property, year or two properties before, they're just trying to buy as much as possible, or they're sizing up and buying bigger things. Like even me personally, I closed on a distressed joint venture property last week. So basically someone came to me with a liquidity issue, pre-construction condo they bought a couple years ago. It was a townhouse specifically, and they didn't have enough money to close on the down payment. So I came in as kind of the white knight situation, provided them a portion of the down payment so that they could make the closing. And then I took a large equity position in the property that normally I would never get as a joint venture, like we discussed before. And, they were able to sleep at night because they made their closing. And I'm super happy because I got an overly large equity portion for the amount of money that I put in.
So when you talk about down payment on a pre-construction, so when you buy a pre-construction, usually why it's like why people do it is number one, they want to make an investment. Number two, you don't need that down payment right now. You usually break it up over the course of however long it's built. So
Exactly.
it probably has money in it, but on closing, you typically need, and I don't know this specific situation, but typically you need, it's 10% down over the course of 2 years, 5% on occupancy, 5% on closing. So
yeah, so it was very similar. I think it was like 25 or 30,000 down in the total closing value. They needed roughly 140,000. So it was a pretty large chunk they had to make up on it. And as you know, what builders are doing now, typically builders are delayed that people are used to. But because of what's happening in the market, a lot of them are speeding up and actually building quicker than people expect.
Yeah.
So he thought this property was closing in summer, and all of a sudden he gets a call, hey, your place is ready in 60 days.
Yeah. It's not even that too. They're like, I closed on one this year and I closed the day.
didn't have occupancy.
I didn't have occupancy.
Oh, really?
Yeah. Like I closed because I remember my lawyer messaged me and they're like, hey, like where are you getting the funds from? And I was like, I'm going into occupancy. Like, I'll let you know in 6 months. They're like, no, you're closing like next week. And I was like, oh shit, I got to figure this out. So
I've been in occupancy on my condo since March. So it is now November and I still haven't closed on my property, which is crazy. So this specific one, I bought in 2019. I put 5% down.
Yeah.
So technically unless you deem it as a primary residence, which most people, if it's an investment property, you aren't moving into your investment. If you have a house and your condo is your investment, so you would need 15% down. So if this is just a tip for people that have purchased pre-construction that is up. So like Cortez was saying, a lot of condos in Toronto that if you bought in 2019 are back to where they were priced at in 2019. So no appreciation. I bought in Burlington in 2019. Mine's up a good chunk. So there are a couple B lenders that give you a mortgage of 80% of the appraised value up to purchase price. So that means I purchased this condo for $500,000. It's worth about $650,000 today. I have $25,000 into it. Okay. I'm going to have an appraiser on close and go value it somewhere around $650,000. And they're going to give me 80% of that number in a mortgage up to purchase price. So that covers the whole $500,000 in a mortgage. So they'll mortgage 500,000 of it. So I don't need a cent more down on closing when I close. And that 25,000 that I already have in it can pay for my closing costs, land transfer, and all of that. I could even get some back. So if I had more of a down payment in, I would actually get paid on closing. The thing is I'm mortgaging more, so my monthly mortgage is going to be high, and especially if it's a rental, sometimes that's not always the best idea if you're going to be wildly negative. I furnished mine, so I get a really high amount of rent for my 1-bedroom condo in Burlington. It is nice by the lake, so it calls for that too. But essentially, that is an option for people that maybe don't have a ton of money in the bank. Maybe you can suffer that extra $1,000 in a monthly payment, but you don't have a big chunk of money to put down on closing.
I wouldn't touch a condo pre-con right now. I don't think it's a good investment.
You know what? I wouldn't either. However, for example, in Port Dalhousie, where I'm selling condos, I took hold of that project because next door, a very subpar building, price per square foot is the exact same as what I'm selling this building for, and this is like night and day compared to what's beside it in terms of what you get, the finishes you get. So when I'm talking to buyers, I'm like, if you go to Toronto and you pay pre-construction and you look next door, you're going to have a $200K discount for what's already built.
Yeah.
So you're hoping that condo appreciates as
20,
much,
30%,
right? So you're hoping for appreciation on closing plus more. Whereas this one, if you look at the comparables, it's a same square footage. So it's going to appreciate like this. You're not waiting for your pre-construction purchase to or the next door building to catch up to what you paid and then both grow. So there are some, I don't think Toronto would be one, that you got to look at what you're paying per square foot and what's around the neighborhood. Because
I think maybe you guys correct me if I'm wrong, but I think people just played the assignment lottery. Like, I'm just going to put in $30K today, and then, once I close on it, I'm going to make $200-300 grand, because people did it like the last 10 years. That's what we saw, right? People just made a ton of money assigning it. And now maybe you could speak to this, the distress sale, like you got in on it. Do you think there's a lot more distress is coming? Do you think that there's a lot more opportunity for people who are maybe in a good cash position to kind of, jump on something that someone, I hate to say it, but someone's hurting and they can't afford to close on it or something like that?
Yeah, I don't think it's anything bad, right? Like, people are in tough situations, and someone coming in with liquidity, like, it's a way better situation for them to sell even at a slight loss and go through litigation and have some sort of issue with it, right? I think what drove the whole issue with where we're at now is, like, interest rates were artificially low for, a short period of time, and most people invested without a strategy and not having right power team members, right? So they weren't using the proper brokers or, mortgage brokers or realtors or whatever to kind of give them advice of like where the market could go. And they just invested with their gut feeling and lack of knowledge and whatever it was, right? But from a distress standpoint, what there is out there is there's a lot of blood in the water, and there's a lot of people willing to negotiate like very interesting terms. So, for those who don't know, there's something called seller financing and like a VTB, so vendor take back, which essentially means the person who's selling the property is going to give some sort of financing on the property to either help you put less money down, or it's going to be a full private mortgage. And then in turn, usually you pay a bit of a premium on the asset so they can get a number that they want. On the residential side, they are common, less common, I would say, than the larger commercial multifamily side, but banks hate them and they end up creating probably more harm than they do good on the residential side. On the apartment building side, where we're seeing distressed buildings right now, anywhere from 5 to like 50 units, I'm seeing people offering 90% mortgages at 4% interest rate right now just to sell their apartment buildings and get it off their books. So I would say the bleeding from, the small individual person who owns a single house to even the big guys that own the bigger buildings, like, there's distress and blood in the water the whole way down.
Why is there distress? Sorry. With apartments, is it variable?
It's a commercial mortgage. So typically, once you fill all of the units, the bank will then appraise it, because a commercial mortgage is appraised on income perspective. So if you fill all of the units, and then they essentially
are they negative cash flow? Is that why?
So
are they on variable rates?
Okay, so if you have a stabilized asset and it's in a larger multifamily building, the addressable market of someone who's going to buy a stabilized building is essentially no one, because there's no lift that you can get from increasing the rents on the building. So it's very hard to get financing on it. And when you do get financing, your loan to value is going to be awful. It's going to be 50-50, which basically means that 50% of the purchase price you're going to have to put up in cash. So when you look at and you calculate your return, it doesn't make sense. So where most people want to buy multifamily real estate on the larger stuff is they want to buy what's called value add. So if you buy a 20 unit building and the average rents per each unit should be $2,000,
Right.
the building might be at $1,000. So what that shows is that there's lift, and if you can renovate units, churn tenants, you can double the value of the building. But what happens is when people buy the buildings, because they don't debt service positively, they can't get commercial financing. So they do something called a bridge loan, just like you do in residential, but it's just more advanced and typically drawn out longer,
Until
maybe
they
1 to
turn
2
over
to
the
3
units?
years. And what we're seeing is a lot of people who went through bridge financing, which is very expensive, they got caught with their pants down in between trying to get to that long-term CMHC financing, and they're having to sell their asset mid-project or mid-conversion. And then those are the buildings that people are just basically divesting of.
Yeah.
So the shorter answer is if you have money, there's a lot of different ways that you can make money in real estate, but you're not going to realize that gain right now, right? You got to buy the asset and you got to hold it till the market comes back. There's no like magical distressed deal that you're just going to buy right now and start cash flowing like $10,000 a month. Yeah. And I think that's like a fallacy that people learned during COVID, or at least thought that you could just buy real estate, buy a couple rental properties and retire and live off cash flow. But the reality is it's not that. It takes 5 to 10 years to really get true cash flow from a property.
Yeah. Yeah. I think too, what you said, like, it's just bad advice. A lot of it was bad advice during COVID. Like even, you had people like first year realtors, like it only goes up. And then when you actually see a correction,
man. It's not sexy anymore.
No, not at all. That's why the sales to new listing ratio, when I'm looking at it, I wrote it in our newsletter too.
I wanted to comment on that.
Yeah.
Let me reopen it. I'm already having people text me about this newsletter.
People like my writing
because it's labeled higher for longer. Bank of Canada says rates won't return to ultra lows. So people are like commenting, and anyways, higher for longer and maybe forever. Bank of Canada deputy says ultra low rates may not return. And that's Daniel Foch. One of our friends tweeted that, which you included in our newsletter. But what interests me is the graph that you included, real estate temperature in Canadian cities. I guess so the higher it is, the higher. Yeah,
the more sales are happening.
So sales to new listing ratios. So Calgary being in the 81th percentile. So that's obviously selling the best. Second is Quebec City. Third is Edmonton. Fourth is Waterloo region. I was at a listing appointment last night and in Kitchener, and I was like, for some reason in Ontario, your market is still moving. And I think it's people from Toronto where it's still affordable, very much. Kitchener is affordable, and you don't have the QEW traffic. Like, it's the 401. It's still the same distance from Toronto.
There's a lot of tech there too, I think.
Yeah.
It's a big enough city where like you can kind of have everything you need there without having to leave.
Yeah.
Like it's a good alternative to being in like big Toronto.
You can get a house for like $700,000, which I know is not like the most affordable ever, but still, compared to Toronto, But
you can in Hamilton as well. So, but Kitchener's outperforming Hamilton like crazy. Anyways, let me continue this. So after Waterloo is Montreal at 46%, then Vancouver at 43%, then London, which is interesting. I have a listing in London that is just not really getting showings. It's a nice side split, and it seems to be slow out there. But anyways, then Hamilton at 33%, then Toronto at 32%. So in Canadian cities, that is, I guess, the standouts. Nothing in Nova Scotia, which is interesting.
Yeah, it wasn't on the chart there, but I think Nova Scotia's seen a crazy return as well, like the prairies have. But yeah, I think the temperature check is true, right? It's the harder they rose, the harder they're going to fall. Yeah. Like, Toronto rose a lot in the pandemic. And then, now it's feeling that kind of repercussion of incomes just not keeping up with prices, variable rate holders.
So what do you guys think about this? So like, I've been fortunate where I've traveled to a lot of places. When I look at places like Shanghai, London, New York, Paris, LA, world-class cities, they went through a paradigm like 50 or 60 years ago where the next generation just expected to rent for forever and never own because
they commented on this.
Yeah, so I think if Canada's a GA country, it's one of the best countries in the world, and Toronto is one of the best cities and one of the best countries in the world. I think we're past that point. And I think the next generation is just going to grow up in Toronto expecting to rent, never own. And
I've said,
just say like this:
owning real estate in the GTA, like the core GTA, is going to be a commodity, just like You go to London, you go to the core in Paris, like you can own in the outskirts for sure, just like you'll probably still be able to own in the outskirts of the GTA. But it's a commodity that only certain, there's no middle. It's either you rent or you own. And then to have the dream of owning, it is not possible. And I think it's going to become a commodity eventually.
Yeah. I think here's a big difference though, is that if you go to London, if you try and own a single family home in London, England, right? You have to drive probably 40, 50 minutes because everything is, there's no
flat.
Yeah. There's no space for them. But in Toronto, you can drive 20 minutes from the core. You can be in Etobicoke and there's all these single detached homes. That's a real issue, in my opinion, is that if you should be in a massive city, you shouldn't be able to have this, big 4,000 square foot kind of family home. It's just the reality because big cities have a lot of people. So the only thing I can see potentially changing Toronto a lot is if it starts to make sense, if these things start to pencil where you can put more houses and you can make more density, it might be an opportunity for someone to, maybe they do own something one day, right? But I do agree, maybe it's something that will just be rentals forever.
An interesting stat I saw, and this is off topic, but Toronto was ranked the friendliest city in the world out of all the big cities. I'm like, what?
I don't know about
the friendliest.
Toronto must be some depressed people in cities around the world.
I always wonder who they poll when they do these things, like what the sample size is, or if they go to the same people, or like what their political leanings are, or their values, or whatever, right? Because I always find whenever I see something like that, it's always whatever I think would be the logical answers. Whatever the article says is the complete opposite.
Yeah, I think Canada just basically needs change, and it's evident in the polling too. The Liberals just polled. I think they just did a poll, and the Liberals it's the worst polling since 2011. And also the NDPs are like catching up to them, like not far off in terms of like number of seats. I don't know a ton about politics, but I'm trying to learn it a little bit more.
NDP, they're proposing relief for people that are struggling with their mortgage a bit. So I'm sure that they'll get a lot of voters, but like I don't think
they're also trying to introduce universal income.
I
don't know how that's
15 minutes.
Yeah, but the people that don't understand economics, like that sounds sweet, It's like, oh, I get relief on my mortgage, or like, no, that comes at a cost.
And there's probably enough people that are struggling right now. Like you hear it everywhere in the streets. You were saying there's blood in the water right now, that their income is suffering so much, and that it's to see somebody else thriving or even doing well when you're struggling. It's like, yeah, universal income. That makes sense. And like, you got to measure how much of the population would actually like that. Cause then obviously there's people that doesn't make sense. That's very much, I always forget the word that starts with a C.
Communism?
Yeah.
Well, yeah, it's more social. It's like it's more like a socialist policy. But I think the downside that people don't understand is like, giving free money is great, but it'll just drive up prices for everything else. So, if you increase your income by $10,000, but then over 3 years, all the expenses go up, like you're no better off than you were a couple years ago.
Yeah. If COVID wasn't the experiment of universal basic income, like I don't know what was, right? Like, everyone had money, and now look at where we are. It doesn't make any sense.
It's true. I think the weird thing that's like, you guys have spent a bunch of time in the US that you notice that's like a weird paradigm shift is I remember when I grew up in Canada, like there was like a narrative that like if you worked hard and like if you were entrepreneurial and you were like, grew up in kind of a capitalist mentality, that was like a good thing. But I don't know when it shifted that like, people really hate people in Canada that are like doing well and like working really hard and trying to focus on like financial growth and things like that. Whereas down in the US, like that's celebrated. That's a mindset that's like instilled in people. Yeah. And the dream, and maybe it's not people's fault in Canada because like the Canadian dream probably has slipped away for a lot of people where they feel like they go to work every day, they work really hard and they should be able to come home and live in like a normal sized house in a good suburb and, have their kind of white picket fence and golden retriever and all the rest of it.
You can have that in the States on a job that you would have in Canada. If you had the same job in the States, you would have that life per se, and I'm generalizing, so don't attack me, but people's salaries in Canada, the same job in the States is much different. Taxes are much different.
For sure.
House prices, much different. So you go and you're a nurse or whatever the case may be, you're going to have something modest, but you're not going to be struggling even to make your rent payments. And that's the sad thing about Canada, and I think it creates that anger in people, that
this divide we've gotten in the last 4 years.
I went to school and I did everything right and I studied hard and like it's like a sad thing to comment on is my sister. She is a very smart engineer. Like she is so smart. She has her pinky iron ring and like very trusted on building restoration of her signature, and went to school for 5 years and studied 8 hours a day. And me having left university and kind of flippantly through school, then got into sales, she's like, what have I done wrong? And it's like, trust me, you did not do anything wrong. But that mentality is like kind of sad, because you work hard to afford yourself a life that now in Canada, it doesn't actually reward you what you thought. So then it becomes like, I worked hard for this amount of years in medical school or engineering, whatever the case may be, and I'm behind people that, you know, maybe got lucky in sales, is their opinion. Like, I think it takes a certain person to be good in sales, but in the States or other countries, the salaries and the tax and the house prices are just different, where that would afford you a good life. And in Canada, it just doesn't.
I think Canada can do that. Like, it's a choice for us to have those tax policies, to like have the housing policies, and like, you know, kind of hold builders by the balls, and like not allow for more freedom of growth, right? Like, if you let the private sector fix the problem and you just remove the red tape, like the private sector would fix the problem, because the demand's there to make the money.
Yeah. Not even in just that sector, right? The oil sector, like, people need to get over themselves, right? We're still using it. And it compounds into everything, into the clothes, into your food. And when you put a carbon tax on something that everyone needs, you have this issue of affordability. But if you do kind of work on oil, and then you have more jobs, you have more people making money, you have more tax money. Okay, let's start there. And then you want to focus on green energy. Perfect. Let's go mine lithium for car batteries, and, you know, work with Tesla as an example to open a gigafactory in Canada. Like, we're just not forward thinking. We're just so like, let's cap everything. Let's not have entrepreneurship in this country. So people go to the States or they go other places. So you're losing that talent to other places, and you're not capitalizing on the amount of money that you could have here.
That video is at like 800,000 views of me talking about the doctor that went to Texas and got a 10-to-1 salary. And it's just because, again, we lost a very skilled individual to money. And some people say, oh, like they shouldn't do it for the money. But like, you got to really think. You got to think. Like, you're not doing it for the money, but like
the person with no money says, why would you do it for the money? You know, like, money talks, and people are free to make as much money as they want. Even Elon Musk, be as mad as you want at him. He's created way more jobs than anyone who's mad at him for what he does. So at the end of the day.
Yeah, money might not make you happy, but what it does is it gives you your time, which allows you to do things that make you happy. And what it does also is it gives you options, right? You have flexibility to move around, do things, move places that make sense. But going back to the tax code thing, like, where I think Canada falls short that a lot of people don't talk on is the United States tax code is very built towards entrepreneurialism, and most importantly, making investments and being able to fail and write off those investments. So if I make $1 million investment in the United States and I lose $1 million, I can write and carry the whole $1 million forward. Whereas here, we're only going to be able to carry half that loss forward. So it doesn't incentivize people like Tesla to build gigafactories and other companies to come here and take large risk, because the tax incentive moving forward just doesn't value it, right? Mm-hmm. And, you know, the downside of that is you get people like Donald Trump who, you know, had $1 billion tax loss once and then just carried it forward for like 30 years and never paid tax. But I think for like the average person or like small business that's trying to take shots at like, you know, entrepreneurialism, like, you know, for them, it doesn't get them any further, right? Because the majority of small businesses fail, and where the tax credits should be put for is like people like that. And especially in real estate too, you got people buying, you know, their first investment property, maybe it's a condo, this, that, or whatever. I guess in real estate, you can write it off. The losses a little bit different, but there's no incentivization for people to kind of take shots and fail.
Yeah.
And I think one thing we just talked about with the importance of like inflation and stuff like that, you know, owning hard assets are very important. So owning things like real estate. But if you don't have that or any hard assets, you kind of just get left behind with inflation.
Yeah, 100%. I think we'll kind of end on this, but I said this a while ago. Canada suppresses entrepreneurship so much that everyone needed a place to put their money, so they put it into real estate. They started buying second properties, which led us down to this path of people not starting businesses, which starting businesses is so important for our economy. So I think that's my
mic drop.
My 2 cents. Anyways, you guys got anything else? That was a good pod.
That is all for me.
Yeah.
No, that's
we'll tag your Instagram so people can find you.
Yeah, where can they find you for people that, you know, maybe you're driving or something?
Yeah, just at Burnstone Capital on Instagram, or just my website, www.burnstonecapital.com. So feel free to reach out. Always happy to set up calls with people.
Awesome. Lovely. That sounds good.
Okay.
All right, guys, thanks so much for watching. This was a good episode. We'll definitely have some short clips for you. If you're on YouTube, please like and subscribe to the channel. We're growing here, so that's kind of fun. And on Spotify and Apple Podcasts, please leave us a review and follow us on Instagram and TikTok for more short form stuff.
Thank you.
All right, we'll see you next week.
Ciao.
Bye.